I'm your host, Brian Rogers, and you're joining me today for one of everybody's favorite topic, which is retirement, or at least, putting that on the horizon and hoping to get there. And the reason I'm excited about this topic today, we're going to talk about getting there fast. We have our guest, 𝗖𝐋𝐈𝖖𝐊, and he is the founder, and he has a YouTube page called Momentum Finance. So it's all about accelerating that ability to retire. Question from Joe, and Joe is asking, so what's the minimum percentage of money you feel an investor would need to set aside each month to reach early retirement by age 50, like you're aiming to do? So what's your thoughts there?
Yeah, thanks, Joe, for the question, and thanks, Brian, for asking it. I think it really depends on a number of factors. For example, what's your current age? How many years are you away from hitting that age of 50 in this example? And then, of course, what sort of investments you are putting your money in. For our case, as an example, as you heard me talk about it earlier, we are mainly investing in all equity, all stocks. And that's why typically with all equity investments, you tend to have slightly higher returns than the portfolios whereby you have, let's say, a mixture of stocks and fixed income. With that said, there has been an article very popular actually by Mr. Money Mustache. Some of you may have already read that article. It talks about the simple math behind early retirement. And what it says is that essentially it's really looking at the savings rate and investments rate, depending on, let's say, when you start. If you are about 10 years away from your retirement target age, you need to be saving and investing roughly 50% of your income. So I know that's a very high number and it's not as easy to get to that 50% rate, but that's purely based on simple mathematical rule and based on the 4% rule withdrawal. Of course, depending on how far away you are from that, hitting that age 50, you can play with that number, take a look at that calculator and whatnot. For our family, we are currently investing roughly about 37 to, I would say, close to the 40% rounded of our take-home money, which again begs the question of how come then we are probably around 10 years away from early retirement. The fact that truth of the matter is that we have also our portfolio size that we've already built, and the power of compounding is going to help us get there faster. So there are a number of factors that have to be taken into account, but I think some of those resources hopefully point you to the right direction to do some of those calculations.
I know everybody's situation is different. Like you mentioned that as well. Like just if you're looking at pensions, if you're including that, that may change your number that you're looking at. Have you ever used, there's a CRA calculator that we've used in some of our classes. Have you ever used that before? I find it really great for putting in your own particular details.
I have not personally used that, Brian, but I think I'm glad you brought it up. There are a number of resources out there that, like, from these reputable resources and reputable organizations that are, I think, really, really beneficial. There was one that I've used it a while ago. It's called Early Retirement Now. And the beauty of it, and I think in many ways it might be similar to what resource that you shared, is the fact that it allows individualization as much as possible, because no one journey is exactly the same for individuals. So, like, let's say we might all start from a starting point, but some folks may have other side incomes. Like, for example, you might have a rental property income. You might have maybe a pension that's coming your way, or inheritance and things of that nature. So based on those unique circumstances, plugging in the numbers, ultimately the calculators can give you a good estimate of where you're headed and what portfolio size you would be able to build by a certain age.
Okay, great. Yeah, I was kind of thinking you might have one that you had up your sleeve too. So that was Early Retirement Now?
That's correct.
All right, excellent. So that's another one we can add for sure. So we have another question from Rachel. And Rachel's asking, saying, I love the idea of FIRE, but I'm terrified that I might run out of money too soon and then not be able to find work when I'm in my senior years. Is this something you ever worry about, and how do you deal with that? And just before you answer that question, Mo, too, can you explain to the audience, what is FIRE? I don't want to scare anybody, like if we're talking about playing with fire.
That's right. Yeah. So essentially, when we talk about FIRE, we're talking about financial independence, retire early. And it has been a movement that has been quite popular, as I would say, for a while. And there's a lot of allure to it, because who doesn't like to have the freedom of time, to be able to have the choice of, maybe only work if you want to, and don't have to work for the sake of, going through the grind of bringing the money because you have to pay your your debts and have to pay for your expenses. So that's really the whole notion of FIRE. With regards to this question from Rachel, I would say the essence of it, I think, is planning really allows us to have a lot more confidence in where we are heading. That's why I think to alleviate some of these concerns and to mitigate some of those risks, we start planning early, we start crunching the numbers, and trying to also go with some more conservative calculations. So for example, if you're a little more sensitive to some of these risks that you've pointed out here, you could possibly try to, in your calculation, maybe play with smaller number of, like a smaller value for the market return. So let's say instead of a 8%, you might go with a 6%, which is a lot safer in that regard. I know on the other side, there are folks that want to get there much quicker, so they tend to play with the numbers and put 10, 12%. So obviously, as higher you go with those market returns, it's going to get harder to achieve that and might, in some ways, get riskier. Trying to plan for it and in different ways, try to also mitigate for that. For us, the pursuit of FIRE, in this case, early retirement, is not something that I would say it's because we hate our jobs or anything like that. In fact, I love my job. I love my current job, and so does my wife. But it's just a matter of, it's about having the power and having the choice. That's what we are trying to strive for. So if for whatever reason, come fast forward, we get to the age of, let's say, 50, and let's say the market is doing terribly that year, it's not end of the world. We have option. We can still perhaps maybe delay our retirement or maybe continue to do a side job on the side, and still make it happen to the best of our ability.
Oh, amazing, amazing. Well, I love the acronym FIRE. I kind of knew what that was before, but you kind of filled it in for me too. And it's a much more exciting acronym than a lot of the banking ones we get, So it is pretty cool, since there's everybody in banking likes to try and shorten things up, and that one I really like.
Easily memorable,
You get
right?
excited about it.
Totally.
Yeah. All right, I have a question from Miran. So Miran is first off saying, "Hey, great and inspiring talk, Mo. Thanks for that. When it comes to financial independence, what 3 pieces of advice would you offer to your child?" This is a really great question.
Yeah, no, thank you so much for that excellent question. And I can definitely relate to that now, having a newborn in our home, and that's our first. There's a lot that comes with it, in terms of what type of behavior are we trying to teach our kid, what type of lessons we're going to portray, pass on to them. So as I reflect on this question, I think the first one, and the way that I try to keep it as simple, is that really the first advice is, it's not about how much you really make. Like it's not about that. It's more important than that is, I think, how much you actually at the end of the day manage to set aside, how much you end up manage to set aside in terms of saving and investing. Now obviously for a child, and early on they won't be able to invest on their own, but definitely they can learn those skills to save money. So I think that's a really an important skill that parents can instill in their kids, help them see the value of their money and how it can really help them have the choice. Which is a nice segue to my second piece of thought process, is around making sure to start investing and saving early on. Really, we talked about it as we saw earlier on through that graph that we shared on the screen as well. The power of time and compounding can really make exponential differences in terms of where you end up. So the sooner your child or anybody actually gets started on their journey, as long as it's a safe, well-calculated journey, I think the better they're going to be off. And the last advice and lesson that I would share is around seeing money as almost an enabler. It's not the be-all, end-all by any means. We are just looking at it as a tool and an enabler to give us the freedom, to give us the choice to do the things that we like. So let's say if your child continues to grow and they're at this stage whereby they just, let's say, finished college or maybe they graduated from university. If they have enough savings already built up by that time, maybe if they would love traveling, maybe they could delay having to start getting a job. Maybe that gives them a choice to do some of the traveling, maybe go see the world if that's something they're excited about, or do the things that matter to them. It essentially provides them choice and freedom.
Oh, I really like that. And I know, well, your child is pretty young, so I don't know if would you end up doing like lullabies or maybe some stories about finance?
You know what? That's funny that you bring it up, Brian. I think one of the things that we could definitely do, and I'm glad to hear. The other day I was talking to my brother. He lives in Australia, and he was mentioning to me how in school system there early on, I think from even kindergarten, they start bringing kids to some of those grocery grocery tours, and they give them some sort of like a fake money and say, hey, you know what? You have this much amount of money. I mean, in simpler terms, of course, so that they can relate to it, and they give them the choice. But even the same thing that parents can do, right? Maybe bring them along, involve your kids at an early age in some of those financial money decisions. Here's how much we have. What are we going to do? Which one are we going to prioritize? We can't, let's say, go for both of them. So which one are we going to go for and why? Having some of those discussions early on in simple terms, I think helps them bring along that journey.
Well, that's great. I've seen that trend myself as well too. I know, when I was younger, it was one of those things. It was a faux pas. You don't talk about money. It's something you don't discuss. And I think it's coming to be a trend a lot more these days with the younger generation to say, hey, like we should put that out there and talk about it a lot more.
Yeah, that trend is definitely changing, and just for me, I know for many Canadians as well. I think there are now. We're very fortunate. There are platforms out there. I know I'm personally very active on Blossom app. Is another app that allows day-to-day investors, day-to-day Canadians to engage in the topic of money and finances and learn from one another. So definitely, I think the more we talk about these topics, the less taboo they are, the better we are off in terms of learning from one another.
All right, awesome. That's a great trend to see. So I have another question it looks like it's from Shanti. And Shanti is asking, would you please share some thoughts on the below funds XE? Oh, maybe wait a minute. Let me actually, I think I had the wrong one. Sorry. That's the one. Okay, we've got, what are your thoughts on all-in-one asset allocation ETFs versus target date funds versus simple index funds as tools to pursue early retirement?
Yeah. There are obviously not a shortage of products and type of funds out there in the market, and that's probably the beauty of it. With a lot of options, sometimes comes the risk of getting confused, and sometimes like the risk of like not necessarily choosing either the right product for your own circumstance, or maybe wanting to have every single type of product in your portfolio. To me and to us, for our household, we try to make it as simple as possible. We didn't try to have every single stock or every single type of fund or dividend stocks or covered call ETFs or anything like that at the same time in our portfolio. We ended up going for what is known very commonly as an all-in-one asset allocation ETF. And there's so many variations of them out there. But so I'm not going to speak to any specific product per se, but as a whole, what we in our household love about an all-in-one asset allocation is that they make the process of investing so much simpler and easier. Because all we need to do is essentially invest in that one single fund, which is already diversified. Many of these funds provide you exposure to over 8,000, 9,000, sometimes 10,000 companies worldwide. So you're not only getting diversification in terms of the number of businesses, but also in terms of the market sectors, in terms of the geographies, like you're getting exposure to Canadian stock market, US stock market, international developed market, emerging markets, all through through that one single fund. So that's something that I've done a lot more reading on, and I'm much more comfortable speaking to, and that's why we are investing in target date funds and simple index funds. I think they have their own place, and in many ways, I would say index funds are components of an all-in-one asset allocation ETF. So, for example, many of these all-in-one asset allocation ETFs consist of multiple index funds, each giving you exposure to a different geography. So in many ways, they're similar. Target date funds, to be honest with you, it's not something that I've really looked into as much. Definitely, there might be a place for some investors, but not something that at least I've been as interested in to pursue for our own household.
All right. Well, yeah, you can do some research out there forever, but the trend in the market I'm seeing too is it's going to more of a one fund, simple solution. So if you do a quick research, you're definitely going to find something, from my experience so far.
Totally.
All right. So we have another question, a really good question from Patrick, that is saying, so you mentioned you started investing about 7 years ago, but you did But did you do this on your own, or did someone provide you guidance and support?
Yeah. So I think my journey has been has had its ups and downs. I did definitely start in the beginning. When I started investing, I started with a managed portfolio. So simple, low cost managed portfolio whereby, let's say, through robo advisors. And there, again, these days there are a lot of options out there. But over time, as I gained my own confidence, I started dabbling into DIY investing. And these days, I consider myself fully DIY investor. That said, still managing to keep it very simple. And I'm very happy that we've landed on that spot. Like, we are in a spot whereby we are almost 90% of our funds goes into a single all-in-one exchange traded funds, which has that diversification and low cost. The reason I said 90%, the remaining 10% is more or less in our RSP account. And for the sake of trying to minimize cost and taking advantage of avoiding the withholding taxes on the US fund dividends that we receive, we ended up having similar but USD currency version of those ETFs. So don't want to overcomplicate it. If somebody is really interested, I talk in depth about these topics on my YouTube channel, Momentum Finance, which you're more than welcome to check out if that's something that interests you.
A great reminder. Yeah, those are on our resources links. So if you're looking for those links yourself, you just check on the top left, and you can go right to the YouTube page and Instagram and Facebook as well. So that's excellent. And so we have a question from Pete. Pete is asking, so what if you're already 50 and earning a low income? I started investing a year ago, making a ton of sacrifices to invest as much as I can. So far, about 17K invested, now worth about 19K. So what would you say? Did you have any advice for Pete?
Yeah, I would say, Pete, and that I definitely understand where you're coming from. I would say in this process, we have to also be realistic, setting realistic goals for us. As much as, of course, we want to be ambitious, we don't want to also overwhelm ourselves. So the last thing I think you want is try to compare yourself, let's say, to others. When you go on forums online, you hear and see people that they're talking about wanting to and actually being well on their path to retiring in their 30s or 40s, and you don't want that to come across as a lack of kind of a barrier to your motivation, and rather you want to try to focus on your own circumstances. Well, my advice may be very generic in the sense that I tell you probably try to review where your expenses are. Are there ways for you to try to maybe minimize some of your expenses and costs? Because if you can do so, you possibly be able to redeploy some of that money towards saving and investing. So that would probably be one way to start, and it's fairly easy. You just have to look at your past 3 months of expenses, see are there actually absolutely necessities, or are they perhaps things that maybe you're doing, but they're not, like they're more like a wants and not your absolute needs. So that's one way. If there is a way for you to try to increase your income, that would be another path. I know it's easier said than done, but another way to look into it. And really, I think in Canada, we are fortunate that there are accredited resources out there that can provide you that financial planning and financial advice, I would say, for a reasonable kind of cost, possibly even for free, depending. I think there might be some resources from the government. So I'm not really exactly familiar with that, but I would say seek out some of those opportunities and don't get discouraged. Like, I think as long as you are determined about your journey and why you're saving and investing, you have a much brighter and more chances of success than many others who haven't even got started, just like you have.
And I think taking a look at some of those resources, like we mentioned earlier, Mo, like you mentioned that I think it was early retirement now, like some of
That's
those
right.
sites, or the CRA also has the retirement calculator. I don't know what the other one's like, but I like the CRA one because it does include some projections. If Pete was looking at, well, what about CPP? Like if I paid into
That's right.
Canada Pension Plan and guaranteed income supplement possibly, and things like that, you can also include in your calculations. And it may not look as bleak in terms of, if you're, depending on when you're looking to retire, if you're looking to retire at 65, you still have some time and you can include those things in the math as well.
You bring up an excellent point, Brian. And the other thing that I would like to add to that is that when we talk about retirement as well, like your lifestyle also defines how much of investments you need to be able to get to that retirement. So for somebody who has a very lavish lifestyle, they have high expenses, and they're going to continue to maintain that lifestyle in retirement, likely they're going to need a much larger portfolio size. But let's say for somebody who has been very frugal throughout their life and they're happy with it, the key point, I would say, being happy. As long as you're happy and that works for you, don't try to catch up with the Joneses and try to live other people's lives. It's your life. It's what matters to you. So try to use some of those subjective numbers that apply to your case.
Excellent. Well, a great question. Thanks for asking that one, Pete. And so we have a question from Mary. Mary is asking, so would you consider early retirement even if you still carried a mortgage? Or do you think you need to be free of all debts before retiring?
Yeah, great question, Mary. And I think that's actually applicable to many of us. Like I know for our household, we do have our mortgage still. And on paper, like in terms of amortization years remaining on our mortgages, still probably at least a good 15 to 20 years left on those. What we are thinking right now, and has been our own personal approach, we have not tried to necessarily accelerate paying down our mortgage aggressively at this point, because we are thinking like, a lot of times the mortgages that we have, at least for us, is fairly, the mortgage rate is fairly decent. Like let's say anywhere between, I would say even 3 to 5% is fairly decent, given that if you invest safely in the market, especially over a longer period of time, there's a good chance and likelihood that you may get returns in excess of that amount that you're paying in mortgage rate. So because of that, we have continued to prioritize investments. Now, fast forward, let's say once we get to that age of 50, and when we get to that point, at that point, I think it just really boils down to maybe also a comfort decision. Like, do you feel comfortable maybe in terms of how you feel when you're retiring, you still have a mortgage? Mathematically, it might be totally fine, because let's say you have built such a large portfolio that still it allows you to have sufficient cash flow to pay for your debt. So mathematically, it could be very well possible. It doesn't mean that you can't retire if you have a mortgage, but maybe from a sleep comfortably at night perspective, you prefer to pay off your mortgage at least so that you don't have that large of a debt coming in. So that could be a possibility as well. Something for us to consider when we get to that age. We are still a few years definitely away from that, and that's why we haven't got quite to that level of thinking.
That makes a lot of sense. All right, well, we have another question. I want to get through as many as we can here. I have another question from Aaron. Aaron asking, as you use to invest, do you think it's necessary for an early retiree to skew towards higher growth, higher risk assets to reach early retirement in a reasonable time frame?
I don't think necessarily folks that are pursuing early retirement have to take miscalculated high risks kind of investments. I do definitely think personally that investing in stock market versus fixed income. So I think that's probably makes sense. Like that's something that we are doing, and the reason I say that is that really based on the body of research that shows while having fixed income or bonds as an example in the portfolio can lower the volatility, at least in the short time frame, for somebody who's trying to invest, somebody who's trying to retire earlier, especially over the longer period of time, getting a higher exposure to bonds may really result in them missing out on the opportunity from a growth perspective in their portfolio. So like as we know, like many times the bonds or fixed income, because they are less risky in the sense that less volatility, it depends how you define risk, of course, but they're less volatile. Because of that, their return tends to be a lot less. And in some cases, you may barely even break even with the inflation that we have these days. And the inflation is has been really high for many months. Gladly, it's coming back now to a more reasonable levels. But those are some considerations I think to have for us. Personally, we do think that we would probably continue to invest in an all equity portfolio, because we are also thinking of mitigating it with some of alternative sources of income. So for example, we are fortunate that we have a pension coming in at the age of 55. So that would almost act as a bond portion to our portfolio. The other things is that, for example, maybe in the year 1 or year 2 of our early retirement, what we could do, we could possibly remove some of our money from our portfolio and put that portion maybe in a high interest rate savings or maybe a fixed income at that point. But really trying to maximize as much as possible until we get so much closer to that retirement age. Again, it's a personal choice. I don't think that what I'm suggesting is something that everybody has to follow. It's really what makes sense to you and what allows you to be comfortable with your decisions.
All right. Yeah, that's some food for thought for sure. And so I have a question. I think we can probably squeeze another one in here from Vicky. And it's a little bit of a long one, but Vicky's kind of putting you on the hot seat, Mo, saying, hey, I was surprised to hear you don't like covered call ETFs. I would think that sort of product would appeal to someone pursuing early retirement. Can you get into a little bit more detail as to why you don't choose to invest in them? And would you consider them once you reach early retirement?
Yeah, great question. For me, the main reason that right now I'm not as interested in them is the fact that I always think about the total return of the ETF or portfolio that we have. It's not just about, for example, how much distributions income we get from the covered call ETF alone, or maybe how much dividend income we are collecting. More so is around at the end of the year, at the end of that 5 years, how much I see the value of that investment's grown in totality. Some of the risk that we see with covered call ETFs is the fact that you do see the value actually depreciates over time, in the sense that even though you're receiving some sort of distribution from that covered call, the price of that ETF is actually shrinking over time. So the NAV, essentially the net asset value, is actually shrinking over time. So something to be mindful. I don't think necessarily those are bad things. There might be some place in a retirees perhaps portfolio, or even for typical investors that maybe need a high cash flow. That might be something for them to consider, not something that we are currently interested in. Maybe as we get closer to early retirement age, we would probably look into it much more closely and see if that's something we would like to pursue, or perhaps be just comfortable with an all-in-one ETF portfolio that we have, and still we decide that we are going to sell a portion of that to create the cash flow that we want. I think at the end of the day, it might give us the same results. It's just a matter of how you go about it.
All right, there you go, Vicky. That answers it. And just for those of you who are wondering what a covered call is, too, if you're not really familiar with that, we do have, if you go into that link where we have the Inside Investing banner, you can click on that. And I mentioned earlier, that'll take you to all the webinars. I know in the past, I believe I had hosted it at one time, there is a webinar that talks about those covered call ETFs. So if you're interested in what those are and what that concept is. So thanks for answering that question, Mo. And I think we're going to wrap. We're pretty much at time. We've only got a couple minutes left. I was going to leave a few minutes for you, Mo, and then I have a couple things here too, or maybe a minute or so. Do you have any closing thoughts?
The final thought that I leave the audience with is really try to continue to educate yourself and keep things simple. Investing and financial independence or retiring early doesn't have to be complex. It's about educating yourself. It's about surrounding yourself with right-minded people. There's so many resources out there. Maybe as a last quick nugget, if I can share, there are a few books that I would highly encourage. I found a lot of value in them. And if that's something that maybe you're interested, you can borrow maybe from a library. One is I Will Teach You to Be Rich, as the name suggests, but the rich is actually both in terms of financial richness as well as richness in terms of your quality of life. The other one is by Canadian couples, actually, Quit Like a Millionaire, which I believe you might have had on your shows in the past. And the last one that I do recommend is definitely a book that I know Dan Bortolotti, you had it previously on your show as well, Brian, Reboot Your Portfolio, 9 Steps to Successful Investing with ETFs. I love that book. In essence of it, it talks about how easy and it can be investing through simple, low-fee investment strategies, and in many ways, through that approach, beat most of the professional money managers. So I'll leave those 3 reading materials for our audience to check out if that's something that interests them.
Awesome. Well, yeah, fall's coming up. You can curl up with a good investing book. Totally. When it gets weather gets a little colder.
Exactly.
All right. No, thanks for providing those resources, Mo, and I appreciate your time. It's been phenomenal. I've had a great time speaking with you. You've done a great job of answering our viewers' questions. Just a last thing for me to wrap up too is to remind everyone there are those webinar and social media links that you can see on the screen. So just on the left there, we have some of the resources for Mo's sites and links, and the other extra webinars from ones that we've done in the past, and then those upcoming webinars as well. And then lastly, there is a survey. So you can click on that survey link. And I believe it does populate at the end, so it should pop up for you. But if you want to click it now and get ahead, if you fill in that survey, let us know how we did. And lastly, Mo, just thanks so much. Hopefully we can have you back again sometime. Would you be willing to do that?
Oh, absolutely. Thank you so much for having me. It's been an absolute pleasure.